Welcome everyone to episode number 18 of the Wide Lens podcast. I'm joined here live from Home HQ, Matthew Rigby, who is 100% dosed up on COVID, and we're going to cover the latest topics in financial markets and investing. And we're recording this on Friday, the 27th of May, 2022. And I just realized that the attire is changing week by week. Matt, you've continued with the casuals, but maybe it's on me, not you. But let's get into Matt's Mark a Minute.
Mate, I've gone cash this week. You've gone very formal.
Got a meeting.
Yeah, so apologies if I start coughing halfway through. I'm getting over COVID. But anyway, okay, so ASX 300 year to date, down about 6.6% for the week, up around 0.5%. Positive news reports coming out this week. Appen received a takeover bid. They're up about 24%. Costa came out with some positive comments at their AGM. They're up a little over 4%. ALS up just under 4%. They had a small beat on revenue and earnings. Technology One down slightly. They also had a small beat, and Elders had a strong first half report. Probably not surprising given what's going on in the world. Negative, New Hope Coal came out with a production downgrade. They're about 2% down. Fisher and Paykel down about 4% for the week. Looking at weak earnings and didn't provide earning guidance for 23, so that didn't help. Incitec Pivot looking to split their explosives and fertilizer business. Just a couple of other things to note. Woodside are now trading under the ticker WDS and not WPL following the BHP purchase of the BHP assets. Tabcorp split out their lotteries business, so that's now trading separately as the lottery company. The marketing department working overtime on that name. And Nufarm down about 10% for the week, with their largest shareholder selling about 16% of all of their stock, which is about 16% of Nufarm. So down a little bit there on the uncertainty. Going to the States, the Nasdaq up about 2% for the week, still down 25% for the year. Year to date, 76 stocks down more than 10%, 13 are in positive territory. And the S&P 500 up about 3.3 for the week, down 15 for the year, around 26% in positive, down more than 10%. And no, I've got that around the wrong way. Sorry, 26% up for the year and 57% down more than 10%. Some earnings. Zoom, the what do we call them? The lockdown darling, maybe, up around 15%. Came out with some really good earnings, good outlook. Basically, their cross-selling is doing really well. So they're selling existing customers new services or more services.
Like what?
What's that?
Like what are they selling? Telephone?
Like the phone. Yeah, the phone side of things, the office
as
phone.
You know, we ditched
they've
out
also got
handsets in the office.
A call center offering. Yeah, look, and can't fault it. I mean, it's pretty handy, and the integration with you click on a phone number on the internet and it just pops up on your little dial pad and off you go. So no, I quite like it. AutoZone up about 7%. Toll Brothers, which is a large luxury home builder in the US, they came up with some good numbers and a reasonable outlook given all the constraints. So they were around 5%. Ralph Lauren was up. Intuit, which is the accounting software business, they own TurboTax, and they also own is it money? What's that? Survey Chimp or whatever that's called.
MailChimp.
The survey online survey business.
Survey
what
Monkey.
Is it? Yeah, that's it. Survey Monkey. I got that all wrong. They're up about 10%. Baidu and Alibaba, the two Chinese companies, came out with some really good earnings and good outlook. So they're up each around 6.5% for the week. Nvidia, they beat up a little, but they didn't have some great comments going forward. And Dick's Sporting Goods up about 6%. So some retailers coming up with some good numbers. On the negative side, Snap, pretty ugly, down about 37%. Advertising just falling off a cliff there. Abercrombie and Finch, the retailer, down 25%. Best Buy, think JB Hi-Fi, they're up about 10%. And Urban Outfitters up about 1%, but they all missed. So mixed results there. Just wrapping it up, emerging markets, down about 2% for the week, still down 15 odd percent for the year. Oil's up about 1%, up 51% for the year now at $114. If you've driven past a petrol station, you'll understand why. And Bitcoin up about 0.5% for the last 5 days, down about 38% year to date, $29,500 per
Hey, I was
coin.
just looking at Fisher and Paykel when you were
at.
talking about that because of the discussion we had a few weeks back around, your idea that the home reno thing continues. Mate, their share price is sitting at
not letting that one go, are you?
Not like $18. They peaked out at $34 during the pandemic. $34.27. They peaked out, and that's almost a 50% decline from where they were peak to today, and doesn't look good, man. It looks like we're giving everything back up for Fisher and Paykel.
Yeah, and look, a lot of those companies, I mean, mentioned Zoom, they're up, 15-16% for the week, but they're well down below where they started pre-pandemic. So, there's a whole lot of companies that have grown their business, grown their revenues, and their prices are back down, which I guess means they're better value. Just trying to look for the PE on Fisher and Paykel, but I can't find it. So, that's interesting. I hadn't realized that they were down that much, but they've been hammered. Hammered.
Let's
let's
maybe roll on.
They're back at. All right. All good. All right. So on Bitcoin, just a chart that we saw through. Who are these guys?
I think it's Bespoke.
Can't remember. Bespoke. There it is. Thanks, man. I couldn't think of the word. We'll bring the chart up now. So this is just the correlation between the S&P 500 and Bitcoin on intraday during US hours intraday moves. And you can see the correlation is, it's pretty high at 75 there, or 0.75. I think gone is the belief that Bitcoin is a store of value and it's not a risky asset and it's not correlated, and all these other things that have been kind of bantered about when times were good and all Bitcoin did was go up. I just thought it was interesting that the correlation, it seems to be getting stronger as markets become more and more volatile, which maybe that doesn't make sense. Maybe that does make sense. I don't know. But that correlation does seem to be getting stronger and stronger. And just a couple of other things on Bitcoin. So Scott Minard, who's the chief investment officer at Guggenheim, he used to be a really big Bitcoin bull. And I was watching an interview with him at the Davos conference or forum or whatever the hell it is over there in Switzerland. And he was saying he started watching and following Bitcoin at about $100. The Guggenheim have been in and out, and they're out at the moment. But his comment was he's expecting Bitcoin to fall to $8,000. Purely based on technical analysis, because in his view there is no fundamental analysis. You can't fundamentally value these things. And he was saying that basically the cryptocurrency market has become a market of a bunch of yahoos, quote unquote. So 2 years ago he predicted it would get to 400,000. What did we peak out at? Like 60, 65 odd thousand, I think it was. Yes, and it
US dollars.
What's that? Yeah, US.
Yeah.
I think it was.
No,
I think it was that.
got. Yeah,
I think it was
I'm just thinking
65
AUD. But anyway, keep going.
And anyway, so he's just saying that, Bitcoin and cryptocurrency at this point has not really established itself as a credible institutional investment. I think that's important. And saying everything is suspect at the moment on the back of what's happened in the stablecoin space. A couple of other comments that he had, which was interesting. He believes once the Fed funds rate gets to 2.25, it's in restrictive territory. And at that point, the economy, the interest rates is starting to contract the economy. He was talking to some Fed officials and former officials, and the one thing he noted is they kept commenting that as long as markets are falling in an orderly fashion, they're not worried.
What does an orderly fashion mean?
So his take on that was the Fed are not going to... Yeah, well, that's an interesting point. He was basically saying if the market fell 10, 15, 20% in a week or two, that would not be orderly anymore. But this sort of trickle down that we've been seeing, that his take was that they're pretty comfortable with that and they're not going to come out with some supportive words and like they have in the past. And the other thing that he noted, a comment which is a really good observation that is obvious when you hear it, and that is that bear markets don't end at fair value. So his view is we're at fair value right now, but he thinks there's more to come. So markets overshoot on the way up, they overshoot on the way down. But he was saying, it's probably around fair value, but he thinks it'll continue to fall.
Bear markets don't
so I thought that was,
end on
just
fair
some
value.
interesting comments.
That's interesting.
Yeah, so they're overvalued. They don't just stop when it's at fair value.
Yeah. Okay. Hey, I'm just going to bring up this chart.
So,
just give me 1 second. I'll just put it in the docs. I remember coming across it on the weekend, and I'll just put it in. Just put it in there now. Can you see that now? And I'll just bring it up as well.
Wow. The hell is this?
So talk about technical analysis. So the blue line's the price of Bitcoin, and then you've got percentage of supply in profit and in loss. And basically what it's showing is, so the red line is the supply in loss, and the yellow line is supply in profit. And so when you have the two converge, you then have a massive breakout in price. And so it happened, look at all the times they converge. And then you've got price in the blue line.
So what's that, 2015? So you're saying when they converge, you get a
breakout in price.
Outbreak on the upside.
And I don't know why. Is it people just coming in and buying because it's gone ridiculously low? But then again, this environment's very different. I totally get that. But if you're talking about technical analysis, here's a bullish chart that's a bullish technical chart for Bitcoin. So I don't know what you think about that.
Yeah, that's interesting. Man, that's a busy chart, but
no, it's pretty simple in my mind. It's
what?
Just percentage in loss, percentage in profit, and
it is.
You've got you've got an uplift in prices. But look, let's time will tell. Let's keep rolling. The Nasdaq, and again, our good friends at Bespoke. I'll bring this chart up now. This is the Nasdaq drawdown from all-time high, closing highs since the Nasdaq began in 1971, and it is currently on pace to close at a lower level than the decline that we had during the COVID crash. And you can see the far right-hand side, the current level, we're basically below that 30% threshold, which is exceeded that of during 2020, and it peaked out in November 2021 before basically it started capitulating from there on in. Now, a couple of things I thought would be really worthwhile pointing out is that we've seen this happen 1, 2, 3, 4, 5, 6 or 7 times excluding the current decline. And I just want to give you some stats. The last 3 30% drawdowns all occurred either right before or early in a recession. As you can see, 2020, you can see '01, you can see '91. The only other two that were not associated with recessions were in '84 and '87. They were the only two times that there was no recessions following from the declines. And so they're pretty high odds for recessions. A couple of other things. The forward returns after the 6 months, forward returns after the 6 other times the Nasdaq first closed more than 30% from a record high, collectively have had better than historical averages, positive. But the consistency of the positive returns, Bespoke point out, was generally weaker than average. 1 year later, the Nasdaq was up by 30% or more 4 times, while the other 2 times it dropped at least another 30%. And so what we're seeing, what they're saying here is that 1 year later, when we hit these periods, 4 times the Nasdaq has rebounded up 30%. The other 2 times it's fallen by a further 30%. And so you can see that in the mid 70s and during the tech wreck.
Right.
And so I don't know, like, where is this? Where's this going to end? Do we continue to see drawdowns at the current pace we are? And I feel like it's a falling knife, but it feels like it's just bleeding very slowly and just this real slow death. We're not seeing these massive intraday drawdowns as we may have seen recently. But what do you think about all of this? We've always been talking about the Nasdaq. We're always talking about recessions and Nasdaq and so forth. But I'm just curious if there's some up-to-date numbers. What do you reckon?
Yeah, look, I think it's pretty interesting from the perspective of the decline has been steady. I mean, what are we, almost 5 months? I mean, we're almost into June. We haven't had, I'd have to check the numbers, but I feel like we had a couple of decent months of declines, then sort of small increases. We're getting a lot of down, 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 up, up, down, 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 up, up, and this week, which we'll touch on later, but this is the first up week we've had, or looks like it will be the first up week we've had for quite a while. So almost relief rallies within a broader, consistent downtrend. I mean, there's certainly a lot of evidence and indication to think that would lead me to think that we're going to have a rally at some point. But whether that's enough to break the bear trend or not, I mean, we'll know in time. But I wouldn't be surprised to see a sort of bounce for a little while. And a lot of it, I think, comes from the Fed. So there's been a little bit of discussion lately that the Fed might have a rate pause. I think they're saying September. So another couple of rate hikes. I think the Fed don't meet at some point during the summer. I think it's August. And then they may not raise rates in September. I think if we get that on the back of an indication that inflation's easing and unemployment's starting to, the hot unemployment market or employment market starting to cool off, I think you're probably going to get a rally off the back of that. However, the broader question is, if we end up going into a recession, if the damage is being done now and continues to be done, it probably doesn't matter if the Fed paused for 1 or 2 months. It might be that the damage has already been done. So, it wouldn't surprise me to see a rally and then maybe a further sell-off at some point, towards the end of the year, maybe early next year. If we go into recession and that becomes evident, I think that's the cause for a bigger sell-off.
Yeah. Well, look,
what do you think?
Yeah, it's funny because I feel like we're having a very similar conversation to the conversation we had last week in the episode, which we were talking about peak inflation, the growth, the year-on-year growth numbers, and whether or not we're in a recession. The pundits are suggesting the GDP growth this quarter is not going to be is not going to tip us over into recession. But it feels like this is either we're living in a recession right now, or this is the easiest recession to spot, and anyone can spot it from a mile away, whether we're in it now or it's coming. And I just wonder if we know where the Fed is going to raise rates up to, which is indicated by the 10-year US Treasury at about, let's call it 3%. Like, if we know that, the market knows that. It's not like that's new information. Why do we keep falling? Is a thing that just baffles me. Are we yet to see the impact on companies? Or are we not believing the economic reports that are coming out? Are we not believing what companies are telling us? But then again, you know, we talk about earnings beats, earnings misses, and it's more like analyst misses rather than earnings and revenue profit misses. So I don't know. It feels like it's the easiest recession to spot. Blind Freddy could spot that we're going to have a recession. Deutsche Bank have come out. I was reading this morning. Their base case is that we avoid a recession this year. But I mean, it's just so short term. You know, we might tip into one next year. To me, I feel like we're doing a lot of the wealth damage, so to speak, in the stock market values, in property values now, in preparation for a recession. And you and I have talked about this, like, we're not going to know we're in a recession until after the fact. And I reckon by that time, market's rallying. Market will rally before we know we've actually entered a recession. Yeah, and I'm a big believer in that.
Yeah, I think you're right. Yeah, no, I think you're spot on. And I think, you know, whether we are or are not now, it seems like a pretty good recession to be having. I mean, unemployment's at record lows and inflation's high and interest rates are rising, but, you know, it doesn't look like there are a lot of people suffering economic, you know, hardship. But
it doesn't mean that we don't have a recession next year.
Like
we talked about this last week during the 2000,
exactly
2001
right.
years. The stock market capitulated in 2000, but we didn't have the recession until April or May of 2001. We may very well be living through a very similar experience. Yep. I don't know. And the fact that companies can't give guidance. I mean, you talk about employment numbers. Apple are just raising employee compensation by 10%. Like, that to me doesn't sound like or look like the labor market's cooling. It's still pretty tight out there, I reckon, based on what companies are saying. So look, let's keep going.
There's a core inflation number that comes out.
Go on.
Sorry, I was just going to say there's a core inflation number that comes out tonight, so that will be interesting and that will drive markets in the very short term.
Yeah, 100%. So the Fed has just revised up its forecast for their preferred inflation, which is at 4.3% for this year, which the interesting thing I found was that it decelerates to 2.5% next year. That's a pretty rapid deceleration of inflation. I think, you know, the 4.3 or 4.5 or whatever the number is for this year, to me, it feels and makes a lot more sense than trying to target 2 to 3% in the environment that we're in. But a deceleration to 2.5 just doesn't sound right to me or feel right. And so what's going on at the moment is comparisons are being made to that of the 1970s with stagflation, with what happened in the bond market, in stock markets and inflation. So I want to get this chart up from Deutsche Bank, and it shows the annualized returns for selected financial market and commodity assets during the 1970s. And so everyone's talking about this repeat of the 1970s. During that time, on face value, equities and bonds just absolutely destroyed investor wealth. And I mean, we're very early on in the decade now, but if things continue to persist, and it's a long, long pathway ahead of us, and so my degree of confidence diminishes as longer that time frame is, we may very well start to see further destruction in equities and in bonds. The things that did really well during the 1970s were commodities. As you can see oil there. You can see silver and gold. But I also wonder if you jump on that bandwagon now, like whether because most commodities have done quite well. Silver and gold, probably relatively speaking, haven't done as well. And so trying to take this playbook and replicate it for this decade, I just don't know how successful investors would be, because you've got your commodities that have run pretty hard already. Although the likes of silver and gold are probably relatively cheaper. The other thing Deutsche Bank point out here is that even though it's probably like a bad thing for financial markets, the fact that inflation could possibly be, this sort of double-edged sword, possibly could be good for helping reduce the debt burden and just inflating oneself out of that, or governments all around the world, especially that of the US. Let me just throw a couple of things out there, and I'm just keen to get your perspective on it. This second chart here looks at the correlation between real bond returns and inflation during the 1970s. And what appears to have worked is those countries that could control their inflation saw positive, you can see in the upper top left-hand side of that chart, were able to control inflation, had a pretty good positive return on their government bonds. And you can see there's just this massive sliding scale from there on in, where you've got negative real returns depending on how severe inflation was in those particular countries. And this is the thing that Deutsche Bank's talking about, which I think is very interesting, even though it's bad for bond investors potentially, but it could be good for the financial system and its long-term stability in managing its debt. Couple of other things, if I can just throw them out there, to your point before, and these are all from Deutsche Bank. I just thought that they really worked well together. The third one is a number of consecutive weeks for the S&P 500, and we've had the equity sell-off for now 8 consecutive weekly declines, and this going back since 1923. And there have only ever been previous declines of 7 or more successive. There only ever have been 3 declines of 7 or more consecutive weeks. And it seems to me that we're absolutely in record-breaking territory here on a number of fronts. Whether this week breaks that, to your point, that we might have our first positive week for a long time, I don't know. Time will tell. And in fact, Deutsche Bank were pointing out that this is the 6th largest non-recession correction in post-World War II history. And so including recessions, there are 15 larger post-World War II recession sell-offs, with like a median sell-off of like 24%. And I'll just get this final chart up again from our good friends at Deutsche Bank. Thanks, Jim Reed. The 6th worst non-recessionary post-World War II correction. And you can see that on the current, it's like a light blue color. I can't show my mouse on it, but hopefully everyone can see that. And so that is the 6th worst non-recessionary decline since World War II. With all of that in mind, I painted a pretty gloomy picture. Like, what do you reckon? Is this the worst of it? When we start really curling up in the corner and shivering, like, is that where we're at right now?
I hope so, because I think that's what it takes for it to turn around. To your point about the consecutive weeks of negative returns and what I mentioned earlier, I mean, it looks like, touch wood, that we're going to have a positive week this week. The S&P, I think I mentioned, was up 3.3% for the last 5 days. So it'll have to be a pretty bad night, I think, for us to tip into negative. Not impossible, but unlikely. And so that would be a nice relief, but that's not to say next week, we don't have another down week. And I think, again, that sentiment is so negative at this point. And then looking at that last chart of, the cumulative returns at negative 18.7 there, again, I guess we keep coming back to this same point, is we could well be in recession, and the markets might already know this, or it's just a panic that the Fed are going too far and going to push us into a recession. So, yeah, I mean, I don't know. At this point, you've probably, as you said last week, go with the odds. Yeah, the odds are that this is going to be one of those years where it's a particularly bad return, but over the longer period and over the next, say, 10 years, the odds are we're going to have some pretty good returns, because the more the market's down this year, the higher are the 100%. Expected returns in future years. And no one knows. Nobody knows. And anyone that tells you they know, they're lying or fooling themselves. But what we do know is, once you go out, if you invest and you go out, 15, 20 years from now, and so I mean that's the one thing that has, repeatedly played out throughout history, throughout 100 odd years of share market returns, buying at the absolute peak, and then going 20 years out, you've got positive returns. So I think for people who are concerned and people who are not sure what to do, keep chipping away, keep putting money in periodically. Don't make big bets. Don't try and pick the bottom of the market, because you're not going to do it. Or if you do, you're very lucky. Stay the course, know the strategy, and just stick with it through these volatile times. And don't invest money you need in the next 12 to 18 months. That should be sitting in cash. And I think if you follow those fairly basic principles, what was it Warren Buffett that said, it's essentially, I'm paraphrasing here, but he said it's a pretty simple game, and for whatever reason we make it incredibly difficult. But just invest and stay there for the long term, be diversified, and just don't try and chase spectacular returns. Just try and chase the average, and you'll come out okay.
I feel like this period is such a good period to put at work these very basic investing lessons that apparently didn't work over the last 10 years for a variety of reasons. But we talk about diversification, we talk about drip feeding money into the market, we talk about discipline, we talk about having keeping the long game in mind. Like, I feel like this is such an important lesson for investors. There has been, for anyone who thinks that there's I've got a guy that's been able to do this for me during these times. Yeah, sure, that may be very well for a very short period of time, but there's just nowhere to hide in markets right now. Real estate, sure, commodities, but not in all commodities. Bonds, stocks, private equity. Maybe the maybe valuations haven't been hit yet, but maybe it's just a matter of time, or maybe we're just not valuing these companies mark to market. So I genuinely think there's really nowhere to hide right now, and even cash. Like, even cash is no place to hide. In fact, let me just bring this one chart up, and I'll finish up on this here. Real total return by asset classes. Now, the grey box is the 2010 to 2021 decade, and then you've got 2022 year to date in blue. Equities, government bonds, corporate bonds, TIPS, which are inflation protected treasuries, and then you've got cash.
Yep.
Even if you think that you're going to sit in cash, even your cash is falling in real terms. And so for investors who think there is some secret corner to hide in the market, please stop hallucinating. There is nowhere to hide in the market right now. It doesn't matter where you are. And there are some great lessons here. And if investors can just go back to basics, as long as you can remain disciplined and you've got solid asset allocation that sort of aligns with your intentions and your expenditure, your life and your portfolio requirements, I reckon expected returns, as more as the market falls, expected returns just keep getting higher. It's as simple mathematics and probabilities as that. I'll finish on that, man. I think there's a lot to learn from there, and I'll hand over to you unless there's anything else you want to talk about on that.
Yeah, look, the only other thing I wanted to say is I remember a couple of years ago I was chatting with a manager, a growth manager, and I remember him saying very clearly, he was like, value is dead. Value managers will never return anything decent again. And I remember thinking at the time, man, that's such a big call, because you're talking about, I mean, who knows? So much can change in a year or two. And I think those big, broad statements, to your point, this is just a huge lesson. And the thing is, most investors will get to learn it again because they'll forget, and markets will go on a tear, and everything will change, and this time it's different, and all the rest of it. But if you can learn anything out of this, and if you're a young investor in particular, markets go up and they go down, and you've got to invest through the cycles. All right.
No one can teach you this shit. Like, you can't go to school and learn about how it feels like to be living and investing in a bear market. You can't learn this.
Yep. No, that's it. It's a life lesson.
Anyway.
And you've got to live through it to know it. All right, so let's move on. I came across this with regard to US property. And the reason it was interesting is, as I mentioned earlier, Toll Brothers reported pretty good numbers. They said supply issues and interest rates were still an issue going forward. However, they were still seeing strong demand. And then I saw this come out from Statista. So I'll bring this chart up now. And so that's new home sales plunge in face of surging costs. Now, there are a few things going on in this chart that really caught my attention. I'm going to call it, I don't know, what's that? Green, dark blue line is the new home sales. The medium sales price is that orange line there. So you're getting this quite a divergence of the number of new home sales is declining while the price is still going up. So that's interesting. And I think that feeds into what has been the case for the since the GFC really, and that is that there has been a deficit in the number of newly constructed houses versus the number of new home formation. So that is basically, let's just say as a collective, the millennials are moving out. There are more moving out than there are number of homes being built to house them. So you're getting this increasing shortage of supply, which probably partly explains the price. The other thing that jumped out in this chart was right in the middle at the top there, the 30-year fixed rate mortgage. So as we've said, in the States, you can get a 30-year fixed rate mortgage, and there are no penalties for getting out of that and refinancing. So in May 2021, the 30-year fixed rate mortgage was 2.96%. So let's call it 3%. And May this year at 5.27. I mean, that's an enormous move in that fixed rate mortgage. So, I mean, that obviously adds a lot of cost to the mortgage if you're buying or locking in that 30-year today, as opposed to what you could have 12 months ago. And there was a senior economist from economic research at realtor.com basically said that it adds about $720 in additional mortgage repayments to the average mortgage in the States. Now, the average mortgage in the US is lower than what it is here in Australia, but it's a fairly significant increase when you kind of compare, when you kind of bring it all back to apples, it's a pretty major increase. So that was interesting. And then I found this following chart, which we'll bring up now. So this is a survey by I think Gallup's annual economic and personal finance poll. So they're basically surveying people and how they feel about buying, or are you looking to, or is now a good time to buy a house? And that number since 2005, I think, is when they started the survey. So we're at all-time lows. So basically 30% of the adult population in the US see now as a good time to buy a home, which is pretty interesting. And I guess that speaks to the interest rate outlook, because I don't think it speaks to the employment or unemployment outlook. So that's just a couple of really interesting charts that I found with relation to the US. And then I was, you and I were chatting about this and wondering what that looks like here in Australia. Now, the data's not as rich and it's a little difficult to find, but we'll bring up this first chart, which is the Australian property market annual change in price. So here's what prices have done, all the way going back to 1996 here in Australia, broken down for each of the capital cities. So you can see, Melbourne has certainly come off there. I think that's Perth that's sort of at the bottom there. What have we got? Sydney and the red one at the back there, which is the 5-city aggregate, all coming off. But Brisbane and Adelaide doing quite well, which is something that we've seen. I mean, it's been a fairly consistent trend for a little while, hasn't it?
Certainly
so,
in Brisbane.
And I wonder what's driving Adelaide. I mean, the population growth is pretty well known about Brisbane, so I'm not sure. It'd be interesting to know what's sort of driving that demand or price growth in Adelaide. Not sure if you've got any insight on that there, Rob.
Hobart's not charted on this, but I know Hobart's been doing equally, if not better, than the likes of Adelaide. Not sure compared to Brisbane, but Hobart's been keeping up quite well as well. It's just the thing that I took out of this chart was like all this fear mongering that property prices are going down. What's happening is growth is slowing. Can we just clarify that?
Yeah.
Slowing down of growth does not equal falling prices. All it's saying is that the prices are not going up as quickly as they were from 1 year ago. Am I wrong? Do I misunderstand this information?
No, that's right. Did I say it was falling prices? If I did, I apologise. It was a falling rate of growth.
No, you didn't.
So you're right. It's a year-on-year trend.
That's what...
That's the narrative.
You didn't say that. That's what we're being told, right?
Yeah.
And so until such time as you've got negative... Until that number falls below zero, it's still growing, guys, right? A positive number means growing. It just is not at the... Brisbane was growing at 30% per annum. Just think about that. That is an enormous number.
Yeah.
And so we're sitting.
Nuts.
Where's Melbourne? Melbourne was about 16 or 17%, and we're just saying, hey, we're not growing at that rate anymore. So just for clarity, everybody, we're not, prices aren't falling as yet.
No. That's a good point. And the last chart here, which is around new home sales. This is from Trading Economics, so we'll bring this up now. It's the number of new home sales across the country, and you can see, if you can kind of erase that, what I'm assuming is the pandemic bounce there, but there certainly has been a trough sort of through, even pre 2020. If you go back to 2017, there's been a fairly steady decline down into 2020, and certainly it seems to have picked up a little since then. Government policy would certainly have a part to do with that. I imagine the millennials moving out of home's got part of that, and interest rates would also play a part there. So that'll be something interesting to watch over the next period of time. It'd be good when we'll have a look to see if we can get total home sales. I know we've talked about it previously, but to get it as a chart would be pretty interesting. But I think to your point, the housing market is still pretty reasonable here in Australia. I mean, it's not like you're getting a ton of houses passed in every week at auctions. Something I've always looked at is, are homes still going to auction, or are they private sale? And I was always told that when times are good, you want to go to auction, and when they're not, you go to private sale. And there's still plenty of auctions around. So one to watch, because housing is such a big driver of future economic growth. And with it starting to roll over in the States, again, something to watch. Granted, they've had bigger interest rate movements, so maybe they're forward in, further down that path than what we are. But it's certainly something we'll keep an eye on.
Just having said that, clearance rate in Melbourne for last week sitting at 58%. It was 70% this time last year. 58%'s not a good number. But I think that number, again, is somewhat misleading to the extent that it depends on what areas you look at. So Doncaster might have a much higher clearance rate than Cranbourne does, or Malvern does, or whatever the case may be. And so I think it's obviously a very broad number, but it's 58% sitting now. The other thing I was thinking about when you were speaking about the chart that showed new home sales going down in the US, but prices sort of still pretty stable. just because you have a decline in number of house sales doesn't necessarily mean prices go down. One, you've got less supply, but two, it may very well be that people continue to pay whatever the price is. So you may not necessarily see prices going down as such. That last chart you brought up from Trading Economics showing new house sales, I agree. If you carved out the peaks of 2020, 2021, it looks like new home sales starting to creep up. And I don't know if you noticed this, but following the election, there was just an avalanche of properties that just hit the market. So no one was putting property on the market until they were waiting for the election results to come in. And I bet doesn't matter what the hell happened, the properties would have come onto the market. So whether it was a Liberal government, Labor government, the Pirate Party, or the Animal Justice Party, whoever came in, I don't think it would have mattered. People would have continued. I mean, if people were to sell homes, man, people want to sell homes. Like, I don't know how much the government controls people's lives to that degree.
No, I agree.
Let's rant over. Let's move on to director's cuts. I found this really interesting from Statista. I'll bring the chart up. It's called the Great Return, and it shows the share of employed persons 16 plus in the US, who worked remotely due to COVID. Have a look at that number coming down from over 1/3 of employed persons. And you're sitting at 7.7% now. And what we're reading is US companies and globally, more and more employers are pushing for employees to come back to the office. And although there is, from what we read, quite a bit of pushback, what the numbers are showing is that people are actually coming back. And so I don't know if it's the fear of the Great Recession that's around the corner. I don't know, but I thought that was really interesting.
Yeah, that was interesting. Do you know if it was people who are back in the office 5 days, or just back at a couple of days, or at some point?
Yeah, that's a really good question. Who worked remotely? The survey doesn't say.
Yeah, okay. Yeah, I found that it's really interesting. That's a pretty, and it's been a pretty consistent drop as well.
Yeah, it has. I don't know where was Omicron? It was December last year. Oh, there's that uptick. So you see the uptick in December, January when 22. It's Omicron clicking up, and it sits at about 15-16%, and then now we're at a 50% decline from there on as well. So, look, I found that interesting in my readings this week.
Yeah, for sure. Now, something that kind of caught my eye: the new treasurer.
Who is our new treasurer?
Jim Chalmers, I think is how you pronounce it.
What's he doing?
So he was asked some questions about inflation and unemployment, and being a politician, was very eager to blame the other side of politics, as they both do, as they all do. I mean, let's be honest. But because
the government controls the global economy.
Of course it does. Absolutely. I mean, we talked the other week about how the people at the ports in Shanghai are worried about what interest rates are doing in Australia. So he came out and basically said, on commenting on the steady decline in real wages, said inflation is almost out of control, which we'll get to that in a second.
Very profound.
Chose to blame the level of almost out of control inflation on inheriting a bad budget. So I guess there were 2 points that kind of caught my attention. Inflation's at 5.1%. So Jim, I hope that is almost out of control, but I feel like you're going to redefine what out of control is in time. Maybe. And the dude's 44, which is about our age. So, he didn't live through that high inflation period of the 70s, 80s. So maybe he's not aware of that. So we'll give him a slight pass on that, although should have studied it in economics. But the second one was that, to your point, that it's nothing to do with the budget. I mean, zero to do with the fact that inflation is basically being imported from all of these other issues that we've got. And if it was to do with the budget, I was reading in I think it was the Financial Review, that Labor had made $7.4 billion of additional spending promises over and above the Liberals. So if it was a budget issue, I'm sure they wouldn't have been making that sort of
inflation would be at 15% if we had a Labor government before. Is that what you're saying?
Look, I don't want to play politics, but it was just interesting, and I think it just speaks to politicians to say whatever they need to say to get their narrative out there, which we all know. So, yes, interesting. You got anything else, mate?
There,
or is that it?
Tips and recommendations?
No, I think we go to tips and recommendations.
Right, what do you got for us?
Mate, so I was out in Healesville on last weekend, contracting COVID. Maybe I got it out in Healesville. I don't know. But anyway, my son's playing a soccer team, so we're out there, and it was a beautiful day. I mean, sunny, quite warm. So we went to a little, I'll call it bar/restaurant called Munro's on the main drag there
the
in
burger
Healesville.
Joint. Munro's Burgers.
Yeah. Are they well known, are they?
Yeah, they're pretty popular.
Yeah, okay. Well,
you would have loved Munro's Burgers, wouldn't you?
Mate, they're gluten-free buns.
It's your kind of place.
Yeah, it was pretty cool. I did enjoy it. So their gluten-free buns are possibly the best gluten-free buns I've had on a burger ever. I mean, they were so good. Wow. And they were incredibly friendly, really accommodating. So we went there with a few families and a whole bunch of kids running around after soccer, and it was just a bit chaotic. We were sitting out the back in the beer garden. The sun was beating down. Didn't have any gluten-free beers, but they had some ciders, and it was just a really nice, afternoon. But no, I'd certainly recommend if you're, gluten intolerant, then absolutely go there. The buns were great, and just the food was really good. So if you're up there, clearly they're well known. I didn't know that, but certainly go and check them out. They were pretty good. I thought I'd found something that no one else had ever come across.
Massive shout out to Paul from Munro's Burgers and the boys down there. They're good bunch of guys. As you know, I was away over the weekend where I spent some time reflecting inward, and I don't think I've had coffee now for 2 weeks.
Wow.
Week previous, week post. But what I did get into, and I know you like your chais, Matt. So maybe next week when you're back in the office, I'm starting to enjoy this. Don't judge me, man. But dandelion tea with chai spices, pretty bloody good.
Yeah.
I made Rachel one this morning, and she really liked it. She was surprisingly, she enjoyed it, even to her surprise. So next week, dandelion tea with chai spices, Matt. All right. I'll make you one in the office and let me know what you think. But no coffee for 2 weeks. I feel okay. I'm alive.
Will you go back to coffee? That's the question. Or are you a dandelion
good question.
tea man?
Deb doesn't want me to go back to coffee. She's like, don't go back to coffee. But I really enjoy just maybe it's the feeling, the nostalgia of coffee. Like, you go to a bakery on the weekend, in the morning, it's autumn, it's cold. I don't know, there's something about that makes me happy. But maybe I could do that with a dandelion tea with chai spices. All right.
Love it.
Do you want anything else to this, or wrap up on that?
No, mate. I think we're good.
All right. Hit us up. Jump on YouTube. In fact, I think YouTube's becoming increasingly more popular. So what you can do as well, for those listening on Spotify, you can obviously continue to listen, but you can now watch the pods on Spotify as well. So listen and watch on Spotify, watch on YouTube, and Google and Apple and wherever you get your podcasts. So all over it. And we'll catch you next week.
All right, guys. Cheers.
My name's Robert Baharian. and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.